Morning, everybody, and thank you for being here today. We really do appreciate you joining us. I hope this is going to be a very insightful hour for you. Couple of things. First of all, please post questions that you might have as we go in the Q&A box, not the chat box. So that's the first one. Second one is just to say if we don't get time or we don't get through your questions, we will respond to you offline, so don't worry about that. And then lastly, just remember this will be CPD accredited, so we'll send out those certificates post the event. So the topic today is finding opportunity in chaos, and there certainly has been a lot of that this year. We're going to spend some time at the start just getting a general picture of the world, and then I'd like to spend quite a lot of it digging deeply into the kind of AI theme and the impact it's having both on humanity and on markets in particular. So Jacques, maybe let's start with a very wide lens here and just get your kind of overall view on the markets, what's happened in the first 6 months and how you're seeing things on the ground.
Thanks, Alan, and welcome everyone. So certainly the AI theme, that's probably been the key theme behind markets, and I think we can touch on it later, will be for a very long time. That's still driving, let's say, the bigger picture story of the market. And then I think overarching or combined with that, the other big picture theme is this geopolitical uncertainty that we predict will be probably a constant feature of the world for the next 10 years as well. I still think that AI is the much more important theme, but geopolitics will be a key part of it. We obviously had that with the Iran war, and thank goodness it seems like some kind of settlement has been achieved there after months of negotiations. Just very pleased for the world that the sides kind of found each other, and that kind of the oil's flowing through there. I mean, we're tracking it daily. It looks like the last week's been really good numbers. So finally, it really seems to be opening up. Where there was a few fake openings, it's now really opening up. And I think that changes the picture for South Africa a little bit, where we were quite optimistic on South Africa at the start of the year. I think the high oil price is clearly very negative for SA. This does open up SA as a potentially interesting idea again. And then just, I guess, trying to think what's the next potential geopolitical events, and also then how does AI accelerate in the next year or two, which is really what we're spending a lot of our time on.
Cool. Okay, so I mean, let's dive into that AI topic, because I think both you personally and the team generally have spent a huge amount of time digging into AI, upskilling yourselves in the space. And I think before we dive into the specifics, let's just start with a basic question. So if you can kind of strip back the theme down to the basics, so pretend we're having a conversation around a dinner table, how would you tell people why this moment matters to humanity?
Okay. So look, my kids are actually like 10, 8, and 6, and unfortunately for them, they have heard this conversation quite a few times, despite being very young, so they know what's going on. So I think that the reason this is just so significant is, like, if you just look at the very big picture, like Earth is like 4 billion years old, and I think life's been around for somewhere around 4 billion years from the first kind of single cellular life forms. But then for that 4 billion years, really nothing changed. Earth was largely the same. I mean, you had some different plant species and like dinosaurs or different animals, but it was largely unchanged. Where did everything change? Like about a few 100,000 years ago when Homo sapiens started, and then maybe about 10,000 years ago when we evolved to be intelligent enough to really change the world. So like Earth is 4 billion years ago, but everything we see here today, like the whole change of the planet, these amazing cities we've built, these beautiful places we've built, all happened in 10,000 years. All because something more intelligent evolved than everything else on Earth. So that really is the key thing that's changed this whole planet. And right now, who would have known, but we're alive at the time, that it seems like a more intelligent thing, or we are building something that's as intelligent or potentially more intelligent than humans. So it's just very clear that if you look how humans have transformed Earth, and we've gone into space and we're going to do so many more cool things, how that will look now that we've potentially accelerated this. So I think it's just such a key point in human history, and this arc we're on. So I think people often want to compare AI to like previous, like the railroads or the Industrial Revolution, other things, which I do think is useful comparisons we can potentially get into to frame what's going to happen to jobs and other things. But this one is really different. And I mean, often you shouldn't say that it's different investments, but you also got to call your shot, and this is just going to be very different from all the previous other ones. It's kind of the trend to define all trends, I think.
I mean, it's a good segue into, so Alex, and I'm going to butcher his surname here, but Alex Sakadot of Whale Rock Capital was doing a very interesting podcast, and he was saying that this is certainly the biggest, fastest changing S-curve of his career. And I mean, he's a storied investor in the kind of TMT space. And he therefore feels it will be the most important S-curve to invest in his career. Do you share that sentiment, and kind of why?
Absolutely, yeah. I mean, let's look back again to like, I don't know, something like a railroads or the Industrial Revolution, that are like the big historic events people often talk about. Those things happened over 20, 30, 40, 50 years. I mean, in Industrial Revolution, when it started, I think like 90% of people on Earth was working in some form of farming to put food on the table, and that's like down to 2%. So that's like a massive change, but that happened over a few hundred years. That was like a long period to adjust. Right now, these things are moving so damn fast. I mean, 2022, ChatGPT came out, and it was, for all of us, amazing. Suddenly there's a computer you can talk to. You don't have to code. You can just ask it questions, and it would actually answer some of them reasonably. And then like a year later, okay, it could pass school exams from like a nice cute chatbot that can like do what humans can do in high school. Then like 2025, like maybe another year and a half, it suddenly won a gold medal at the IMO, which means it's now a top 100 mathematician in the world. And then like this year, it passed the best coder in the world, and it's solving unsolved math problems, so it's also passed the best mathematician. So it's like 4 years we've gone from, oh, look at this cute toy you can chat to like, okay, it's smarter than the smartest human in the fields we thought humans like really excel at, being like coding, maths and physics and stuff. So it is just going at like warp speed. And if you look at how these models get better, you throw more compute at them and you put more data in it, both of those trends we are going to keep doing. So there's just no current reason to believe that this curve will stop. So it's just, if you can think of like from 4 years ago, something you can barely chat to like something that's already superseding humans in various levels, it's really hard to predict 4 or 5 years forward right now, right? If you look at that S-curve.
Okay. I mean, I think maybe just to help a skeptic or a layman listener like myself, right? So these exponential curves that you are very comfortable with and my brain doesn't compute. Explain to me what that looks like 4 or 5 years from now. Because I mean, one of the stats that somebody threw out the other day was to say that Anthropic added, I think it was the entire, or more than the entire collective revenue of some of the largest software businesses in the world within a month. Now that's a mind-blowing number. First of all, what was kind of your feeling when that came out? And second of all, what does that mean 2, 3, 4 years from now?
Yeah, I think it's just stuff we have never seen before in capital markets that's happened. So I think to give you some context on that, Anthropic. So at 2025, it ended 2025, so last year, with I think $9 billion annual run rate. And that's up from $1 billion the year before. So it like basically 10x in 2025. And that's up from $100 million the year before. And I think the year before that it started. So it's like, it's just done 10x every year, which is like, sometimes you'll see a small startup start with 10x in the first year because it's off a really small number. But then ending 2025 at $9 billion, and I think from what we hear now, it's at $47 billion annualized revenue around a kind of end of May. So that's another 5 times in like 5 months. And I think the comparison there is, people looked at the largest 3 software companies started in the last 10 years was like Databricks, Snowflake, and Palantir. They ended 2025 with like $10 billion of combined revenue. That's with each of them having thousands of salespeople. Over 10 years, they built up that revenue. And then Anthropic added that in like Feb and March this year, like one company just in 2 months. So, and it doesn't seem to be slowing, right? So clearly, that also shows you it's different. I think what happened in the tech boom is like in the late 90s, people were really excited about this idea of the internet. But basically, you had websites being started, but there was only like a few million people on the internet. So it was like some dream of the future, but people weren't really massively using the website. Everyone was still shopping in the real world. We laid all this fiber across the Atlantic and all around the world, but the fiber was hardly used. Right now, every GPU that's installed in the world is pretty much running at 100%. And people are paying for that because it's so useful, and obviously you see that in Anthropic revenues. So I think let's say probably 9 or 12 months ago, we were still somewhat unsure about whether the very high capex numbers people are spending on AI or data centers would make sense. I think this last 6 or 9 months has proven without a doubt these models are exceptionally useful. Individuals, and especially in our companies, are willing to pay for it. And because they're paying that revenue, that kind of funds this whole system. So the key kind of almost flywheel here is, can the AI products be useful enough for companies that they want to pay these amounts to be more efficient, to move fast, to code fast in their businesses, and that kind of makes everything work. And for now, that's running beautifully.
So, I mean, maybe just to follow up on that, then is the feeling that as the world stands currently, that revenue run rate is real and durable and not kind of everybody just playing with the new toy that happens to be available to them?
I think if you, like, we use it like aggressively in our business and in all parts of the business. I use this at home, and I coded back when I was in high school, at university. I then haven't coded for like the last 15 or 20 years. It is just coding is the most clear use case where you can build immensely amazing tools. Like my kids are both into chess. I built an awesome, so we had a problem. They don't want to practice chess because like in chess, if you play against someone of equal rating, you win half the games and you lose half the games. But obviously a lose is much more painful than a win. So I had unhappy kids for a lot of the time. So I built them like a chess.com type tool where they can play against something, but they can basically always win. If they make a mistake, they can learn from it, but take the move and win. And now it's great. This would have, I asked actually the AI to estimate. It would have taken 2 full-time developers 2 months to do this. And I sat there on a Saturday night and a Sunday morning kind of building this for them with kind of my Claude subscription. So it clearly just is incredibly valuable. So I think without a doubt, companies will keep paying for it. The key thing we debate a lot in the office is how fast the AI continues to improve, because that'll really define how quickly companies are willing to pay more. If it's from kind of being equivalent to 1 useful staff member to being 5 or 10 useful team members, and it massively accelerates your growth, you'll obviously be willing to pay more. So currently, as I said earlier, because of the more compute we're throwing this and more data, it's highly likely to us the models keep getting better. The major new risk that has potentially emerged is obviously the US government banning Mythos. I mean, for people not aware, like a few weeks ago, they said Mythos is too dangerous as a hacking tool. So until Anthropic can put guardrails on it where you can't use it for hacking, we're going to ban it. That's probably the major risk to revenue growth, is if the models start being slowed down by 3 or 6 months before they get released because of government regulation. I don't think it's that easy for governments to do it because you always have China and open source nibbling at the heels of the leading models. So I don't think practically they can hold them back. But our bet very clearly is the models will keep getting way better, and as such, companies will want to use way more of them, and there'll just be excessive demand for these models for many years to come.
So, I mean, I suppose one of the elements of how attractive a theme is how far along the adoption curve of AI we actually are. And it feels, or it certainly sounds like from many commentators, that actually the adoption levels are incredibly low relative to the total addressable market that is available to them. I mean, would you concur with that statement? What's your view on it?
Yes, I would think we are very, very early in the cycle of using this. Certainly, like let's say large companies that are effectively the companies with the largest revenue and the biggest money they can pay, they typically slow adopters of new things. They need to make sure it's safe, their data doesn't get leaked, it doesn't corrupt their existing code. So they will slowly but surely, they'll maybe first test with Microsoft that they're comfortable with. Then in time, they'll give a few people Claude or ChatGPT licenses. So that is a slow process. It takes several years for that to go out into the economy. I think clearly this year it's starting to take off if you look at that kind of Anthropic revenue we just discussed. And I think the key thing to think about is, like, it's very hard to understand how large the demand for AI really could be. Like where agents are now and where I think they'll be in a few years, you could imagine that, let's say some of the wealthiest people in the world, like Bill Gates or Jeff Bezos, they probably have like 20 or 30 assistants of various kinds that does various things in their lives to, I don't know, look at their health and look at food and clothes and holidays and kind of managing your house. I think with AI agents in 3 or 5 years, like pretty much everyone is going to have 20 agents doing whatever they want for them. So basically from, like right now, I'm a high user, you're probably a reasonable user as well, because we love AI here, but I think we're probably in the kind of 1% of people, or 0.1%. Our usage is probably going to go up 100 times. I think everyone else's usage will also go up. So my suspicion is that we are like, I don't know, way under 1% of where this is going to get to.
So, I mean, there's that curve that they talk about, is kind of your tinkerer, early adopter, kind of early mainstream adopter, and then mainstream. And this sounds essentially like we're still in the tinkerer phase of this part, where it's actually driven by a small number of people who are, and I mean, it does feel that way as well, right? Because when you are utilizing it, when you are learning about it, there's no obvious way to go out and learn how to utilize Claude effectively. I mean, you can't trolling various people on X or whatever to get the best advice. So I think it does speak to that element. Absolutely true.
Yeah, I mean, we've certainly got a few developers in our business that's almost all day speaking to it. That's where you've got a bunch of agents running, and your job is really just managing a bunch of agents doing work for you now. So that would be like the real front end of it. So we have got some vision into that. And I think at the AI labs, everyone runs like that at those labs, but that's the very front end, and then the rest of us are just various stages behind.
I mean, I suppose the other thing that tells you about this is the kind of war for AI talent, right? I mean, I think Google share price dropped like 5% because one particular developer left to go to. I mean, that gives you a good indication of how valuable these people at the frontier actually are.
Absolutely.
Yeah, no, it's amazing. Cool. Okay, so if we can kind of now zone in a little bit into the various layers of the investable universe, so to speak. I mean, it's obviously going on Jensen's five-layer cake of AI, but starting at the foundational level, which is essentially the kind of watts and wafers, so hardware and energy, but I think let's focus most on hardware. Data centers previously, for like the last 40 years, have been an incredibly boring place to be in the world. It was very commoditized. You could, there was nothing that kind of differentiated one company from another, and returns in that space have been mediocre at best. Obviously now you've got a situation where every layer of hardware is kind of being pushed to its physical limits. There's incredible shortage of every input that one requires. I suppose first question is, why is this happening? But followed up is, how long do you think that that lack of supply is going to persist for?
Yeah, so I think it's a very interesting dynamic, and again, it's something we've discussed a lot in the office the last 18 months. So the reason the last 30 or 40 years that has been fairly boring is based on purely the technological trends of things getting smaller and people getting better at building things, like chips and RAM and everything improves by about 30 or 40% a year. So for the same amount spent, you can buy something that's about 30 or 40% better. This is like Moore's law. Basically, every few years, computing power doubles at the same price. And over the last 30 years, that has been enough for what we needed. Like every year, your Netflix and your YouTube stream is at slightly high quality. Your TV is slightly high quality. The website you go to uses slightly more. Your laptop upgrade from 4 years ago is slightly better, but it's on that 30% curve. So because of that, like there's enough chips around, and you don't have to pay excessively for it. The tech industry took care of that. So because of that, what happened in the last 30 or 40 years is you don't really have massive growth in data centers, and you have up cycles and down cycles. And the down cycles, the kind of weaker players go bankrupt. So what happened is a lot of these semiconductor sectors consolidated to only 2 or 3 players over the time to survive these tough cycles. So you have, like RAM, we're down to 3 players, Micron, SK Hynix, and Samsung. Everyone else has died. Hard drives were really 2 listed players. Like Toshiba's small, but it's really like Seagate and Western Digital. Even like on logic chips, like TSMC is by far the biggest, and then kind of Intel's a bit of a distant second. So most of these industries, because it's been quite a tough sector, has gone down to 2 or 3 players. Now all of a sudden we figured out how to turn that compute into intelligence. And now suddenly, okay, the world wants like 10 times more, okay, not 30% more per year. So you've gone from demand growing 30% a year and supply growing 30% a year. So suddenly we like want 10 times more. But they used to making like a tiny bit more every year because demand's on a smooth curve. So this has obviously completely changed how this industry works. And you've seen this just all throughout that semiconductor industry. So RAM pricing, again, RAM's probably fallen by 30% per annum very consistently for like 30 years. Oh, yeah, probably 30 years. It's like up 7-8x for RAM kind of in the last 12 or 18 months. So like it's just very suddenly completely changed how this industry looks. So that's probably the biggest change we've made to the funds the last 18 months is figuring out we've got to spend a lot of time on this. Basically, the whole world is getting rebuilt to run on AI. And what is the key input to AI? It's these semiconductors. You need the RAM, you need the hard drives, you need the kind of CPUs, you need the GPUs. So this clearly is the picks and shovels of this AI gold rush, and we need to get our heads around this. And that's probably the biggest changes we've made. It's the most time we've spent is learning it or studying as many of the companies in this sector and making sure we're well positioned to identify the potential winners in there.
So, I mean, in terms of just following up from that, if I think of like the commodity cycle as a reference, gold prices spike, miners decide to bring on new mines because it makes sense, but the time frame to get to that is quite a long period of time. Is that similar for these types of players, or could new entrants come into the market and bring on a lot more capacity quite quickly?
That really is the key debate here, is figuring out what's the answer to this question. And precisely that. Historically, when I said demand was growing at 30 and supply was growing at 30, if at 1 year demand grows at 20 and supply grows at 30%, then suddenly you've got a 10% oversupply, and then prices of RAM and hard drives fall and a few guys go bankrupt. That's typically same for like a platinum cycle. If demand is just slightly below supply and there's too much of something around, the price collapses and prices go way down. So a few things have happened here. Because these industries are oligopolies, these companies have seen so many bad cycles that a year or two ago, when the demand started increasing, they're like, okay, we're not going to invest this time. We've learned our lesson. Like every time we've seen this demand spike, we expand capacity, and then a few years later, it all goes pear-shaped. So we're going to wait for a year before we do anything to just see if this is real. And obviously, this one was the real deal. So firstly, we lost like 6 or 12 months where they could have been building. And then secondly, there are just real constraints in terms of how fast you can expand capacity. Like firstly, you've got to build these giant new fabs with huge clean rooms. It takes a year or two to build the site. Then you've got to get the machines. ASML, like a company from the Netherlands, is the only company that makes the machines that helps you make the RAM or the chips. They've got a backlog of machines. So firstly, it takes 2 or 3 years. There's kind of a backlog in all parts of this chain because it's been built for a very slow, moderate growth industry. Now suddenly you're a rapidly growing industry. The whole value chain just can't meet this. So I think everyone now is going to try grow supply by 20% extra per annum. Okay, so that will start happening. Firstly, it's probably 3 years out because of the time lags. But again, what we see is, because these models keep improving, we think the demand will just keep growing at 40, 50%. So there's every likelihood that 5 years from now, possibly even 10 years from now, we are just still undershooting because the demand for these things is so high, because basically you're literally making intelligence out of sand at the end of the day. It's like sand is the input into semiconductors, and obviously you got to have these fancy machines and you make it into intelligence. There's just endless demand for this. So that's the key thing that we are watching, is what's happening to demand and supply. And currently it seems to us it's very likely demand significantly exceeds supply for many years. The moment you obviously want to get out is when it's clear that supply does eventually meet demand, or a year or two before that. So that's what we're constantly debating.
Cool. Maybe just to finish up on this side, where do you think in that chain is the most kind of durable competitive advantage currently?
So that's a very hard one, and again, something we try to think about all the time. And it's also not necessarily, you might not in the short term want to be invested in the most durable competitive advantage. You maybe want to invest right now up front where there's the biggest shortage. And RAM, for example, and hard drives, but specifically RAM, has been the area of biggest shortage, because these GPUs that NVIDIA make, they just use a lot of RAM. And especially now that they can think, all of you might be using the thinking models that reason, you've got to keep all that stuff in the AI's memory, so you need a big block of RAM for that. So right in the short term, RAM is slightly easier, I think, to make that than the chips at TSMC. But if there's a bigger shortage in RAM, it doesn't actually matter that much whether it's durable or not. It's where's the biggest shortage. The biggest shortage will mean the biggest price increase and the biggest profit increase in that companies. So early in the cycle, it might actually be optimal to just invest for the biggest shortage and not the most durable position. And then as the cycle progresses, maybe where we are now or some time to come, you want to start looking where's it most hard to replicate what the company has. And then maybe at TSMC, we think is very well positioned. It's quite hard to replicate what they do. Even in ASML, it's unfortunately well priced for that skill set as a very unique market position. So I think at different points in the cycle, you want to own different things. David always says, in a hurricane, even the turkeys will fly. So sometimes early on, you actually want to buy the turkeys and not the best business and let them fly.
Fair enough. Okay, maybe if we now move to the next piece of Jensen's layer cake, which is the hyperscalers. This is probably the one that everyone's most au fait with, because it is the big listed name. So the Microsoft, the Google, the Amazons, the Metas. But from your perspective, currently, who's kind of winning in that space? Who's losing, and why?
So what's happening is all of them are seeing insane demand. So every one of them, as I mentioned earlier, all the GPUs are sold out, and the GPU rental prices are actually going up. So typically what you do is when you buy new GPUs, for the first few years you get a nice high rental rate, and then as newer technology comes out and you sunset the older stuff, the rates drop. Right now it's so in demand, even the stuff you bought 3 or 4 years ago are now actually staying the same or getting upwards revisions when the rentals expire. Because you're basically renting out chips. That's the business model. All of them are spending massive amounts of capex. So I think those stocks haven't done nearly as well. Some of them are actually flat year on year, and we can talk through the individual ones in the semiconductors. And the reason is they will have nice growth and higher growth down the line, but obviously in the short term, they've got to spend a lot of capex. They've got to send all their free cash. Basically, all their earnings they make is being sent to these semiconductor companies. So very simply, from an investment perspective, it feels somewhat obvious to say, maybe I should just buy the companies that everyone's sending all their money to. And that's the semiconductors ones right now. And that was kind of the thought process the last 6 or 12 months for us, is if every large tech company is using every cent of earnings and sending it to this group of companies, it just seems you should be owning them. Obviously what will happen in time now is when they get those chips, they rent them out and their own revenue will accelerate. And down the line, their earnings will grow very aggressively. So we think all the hyperscalers will accelerate well into the 30s. Google's growing almost 100% in their cloud business right now, because they came off a lower base. So if we go through the three, I think Google is probably best positioned because they make their own GPU. So they don't have to for a lot of their cloud business, they don't have to pay NVIDIA's very high 75% profit margin to get NVIDIA GPUs. They get some NVIDIA GPUs, but mostly they make their own GPUs and they effectively capture that margin in-house. So that's, I think, why they're doing best, and also why their cloud business is growing the fastest rate. Amazon do make their own CPUs, and have also for the last few years started making their own GPUs. They're a little bit behind Google, but again, fairly well positioned. So again, there we like the Amazon story. And then Microsoft is the one that's probably most behind, because they're behind on their chip program. They're designing it still, but they haven't got a chip out there. So right now, they have to pay NVIDIA more. So we were just looking at the large three hyperscalers and their relative positioning. I think Google's best positioned, the Google Cloud business. Amazon number 2 with their Amazon Trainium chip that competes with NVIDIA. And Microsoft, I'd say, is lost for 2 reasons. Firstly, they don't have their own chips. So when you want to rent out a chip, you've got to buy an NVIDIA chip, pay NVIDIA 75% profit margin, and then rent out the chip, where obviously Google and Amazon don't have to pay away that margin on their own chips. And then secondly, the big debate, again, which maybe it's worth getting onto later, is how does AI impact software businesses? So firstly, technically, you could say you can develop much more software much more cheaply using AI as a Microsoft and software business. So that would be the positive. Alternatively, it's much more easy to compete with you. Companies can build their own tools. New startups can build tools faster. So for the software part of Microsoft, that's maybe half the value, and half the value is their cloud business. There's some real question marks there. So Microsoft's actually done quite poorly the last year or so. Amazon's somewhere in the middle, and Google's done fine.
I mean, maybe just staying on that Microsoft software portion. I mean, we will cover some of the other software names just now, but do you think that having the distribution, so the embedded usage by a large enterprise, is enough to kind of carry them through? Or at what point do people start transitioning away from I mean, Copilot is now collectively known as Clippy 2, which isn't a great indictment on them. But I mean, there is friction in moving your entire software business to either something that's built in-house, and we can talk about that in a second, or to a new competitor.
Correct. So that's a key area where the market's view is somewhat evolved over the last year. So a year ago, some of you might remember the time DeepSeek came out. I think it was early last year, and this was a Chinese open source model that was quite close, maybe a few months only behind the leading models at that time. And at that stage, people thought open source would permanently only be a month or two behind the leading models. And also at that stage, like OpenAI was ahead, then Google would jump ahead, then Anthropic would jump ahead. So it wasn't ever clear which model was in the lead, and everyone was quite close together. So at that stage, the theory was you would stick with Microsoft, you'd use Copilot, and within Copilot, you just select whatever the current best model is. And that's actually fine for Microsoft, because then they've got you locked up, they've got the corporate relationship, and you stick on Microsoft and you use them to pick the model. I think what's happened the last 9 months is very negative for Microsoft, in the fact that Anthropic has quite clearly pulled ahead in this race. They, with agentic coding starting at the end of last year, their coding product became better. And I think what's happened internally is, because they've now got the best coding AI, they can develop their own model faster. And then they came out with CoWork. That's been amazing. They recently came out with a Slack and I think Teams integration now. So suddenly they're like 3 or 6 months ahead of everyone else. So now for companies, they can't get this Anthropic products if you go through Microsoft. So suddenly you're seeing large companies directly dealing with Anthropic. And once you deal directly with them, and you now have a direct partnership, then you've cut out Microsoft, and then you've lost that, because now the company's signed up with Anthropic anyway. Why do you use it through Microsoft and them? So the way it's worked out, where a few models are clearly in the lead, if it stays that way, I think that would be quite negative for Microsoft, because then the fact that they've got the relationship doesn't matter. You need Anthropic in your company, and you're just going to phone Anthropic and say, I want 1,000 licenses.
Got you. I mean, maybe just on the CapEx spend specifically. So there's obviously been a lot of debate as to say, and I mean, the numbers are mind-blowing, right? I mean, I think the forecast for next year is like through $1 trillion or something nuts. Is this, and maybe we can speak specifically about each individual business, but is this disciplined capital allocation by guys going, we will get a good return on investment here? Or is this just an arms race to kind of, we want to be in the race to AGI, and in order to do that, we're just going to throw money at the problem?
Yeah, I think it's a little bit of both of those. And again, we have to assume that because they're sitting in these labs and they probably see 2, 3, or 6 months into the future, they've got access to the models being developed. They've probably got slightly better visibility into that. So when, let's say, 3rd, 4th quarter of last year, the CapEx numbers really started to be revised upwards for 2026 and 2027, we were initially worried. And we were thinking, look, it's these large tech company owners, they're all worth $100 billion. And they're basically saying, we've got all the money we need. let's have a go at making the AI God. We want to be the first company to make AI God. We're going to spend all our money for that. Now, that as a shareholder is probably not something you want to back. It sounds like a pet project, but we want returns, not having a go at building that. However, what has since emerged is with the rate of progress in these models, it does seem likely to me that people will just buy up all the compute that's available for the next few years because these things are so damn good. So maybe to be fair to them, maybe it wasn't that. Maybe they were just seeing how good these models were going to get, realizing companies would want as much as they can of this. Like right now, sometimes when we want additional compute, even in our business, it's like you've got to be on a waiting list and stuff. It's just like all the GPUs are rented out. It's just that in demand. So clearly for now, that decision has been correct to spend the capex. Obviously, the question is, do you spend it? And then for some reason, either the government stops letting the models improve, they pause it a little bit, or potentially there's some really big efficiency improvement in the models, and maybe you don't need all that compute. I think even the efficiency improvement seems unlikely because the way these models work is the longer you let them think, the better the answer. So if there's an efficiency improvement, I think people will just let the models think longer, and you typically want the most intelligence you can get. So I do think it's rational, but I think markets are always scared when companies are suddenly spending, like these companies had built up cash on their balance sheets for the last 10 or 15 years. Suddenly you're spending that entire cash pile you had saved, plus all of your current earnings, and now you're taking on debt, and Google even recently issued some shares. So I think people are clearly saying, wow, these numbers are going to be very big. They better be right on the return on them, which I think why there's probably legitimately some level of uncertainty. Where for the semiconductors companies, again, you don't have to take the view, all this money is being sent to them, they make huge margins on it, and they don't have to gear up or spend their free cash flow taking this risk.
Cool. Maybe let's just move on to the actual model businesses here. I think the prevailing wisdom a while ago was to say that the models would become commoditized, i.e. it would kind of be somewhat of a race to the bottom, and they themselves would have very little differentiation between each other. That doesn't seem to be the case currently. As you mentioned, Anthropic's gone well into enterprise. It looks like they've got a good lead. It looks like there's some brand associated with these things. Do you think that ability will sustain itself? And then what does the market structure look like at the end of that? Will there be clear winners and losers? Will you get similar to the cloud business where you've got 3 or 4 large players that kind of dominate the whole thing?
Yeah, again, this is a key point of debate for us. I read a lot of sci-fi when I was younger, a bit of a sci-fi nerd, and the key to understanding this debate is this concept of recursive self-improvement, which is like you read about this in the sci-fi books and it's nice, but you don't think it's ever going to be real. And like a lot of the stuff in the sci-fi books is suddenly quite topical. So what recursive self-improvement is the AI model becomes good enough that it can largely make the next version of itself. So it's good enough that it can write the code to improve itself to become smarter. And then obviously that smarter one can even faster write the code to improve itself. And this really was kind of this fanciful kind of thought experiment many years ago in the sci-fi novels. But what's clearly happening in Anthropic right now is the moment they got agentic coding towards the end of last year, I think most of their coders right now don't write code anymore. And I think that their Intel numbers is the average coder gets 5 to 8 times more done right now versus kind of 2 years ago. So that is staggeringly fast. So we really are, currently you still have humans involved in the process, but you really do have, the AI is effectively writing 90% of the code for the next AI at Anthropic right now. So we are in the early stages of this recursive self-improvement. Right now you've got humans directing it which way to go and which kind of code to write and which experiments. But all of them suspect that in 12 months' time, even the AI research part will be significantly accelerated by the model, even helping the AI researchers to say, what do we research next? What's the next direction we go in? So if that becomes the world, then I guess being 6 or 9 months ahead of the other models is actually not a lead the other guy that they can never catch up to, because you effectively have the 9 months ahead model that will faster and faster give you the next faster model. So we really are in the cycle. So my view has changed on this one. Where 12 months ago, I thought it would be 3 or 4 labs kind of constantly beating each other for the newest model, and then open source would be like 3 months behind or so. That was kind of our base case in the office. Right now, you cannot be sure, but it seems quite possible to me that you might end up with 1 or 2 winners down the line. Like right now, Anthropic's clearly in the lead. Maybe OpenAI is like 2-3 months behind. I'm not sure. They're going to apparently release a new model in the next few months. Maybe it's closer. And then even Google's fallen a bit behind, and then open source is kind of another leg behind. So right now, that gap's actually opening up, and I think it's because of this recursive self-improvement theme. And that changes a lot of things into how this landscape eventually plays out if you've got a few big model providers that's way ahead versus everyone else.
Maybe on that point, so obviously the overwhelming majority of value has currently accrued to these businesses that are at the frontier, right? The guys that are releasing the newest and greatest. And there does seem to be kind of an unbounded willingness to pay for that ability. I mean, the Fable, which existed for 48 hours before it was removed, was kind of 2x the price of the previous model. Why are people so desperate to use the latest and greatest model as opposed to, say, the open source stuff, which, as you say, is 80% of the way to the frontier number, but yet we all seem to be very keen to pay up for the new stuff?
Yeah. So it turns out that in a capitalistic economy, intelligence is really, really useful. Like, I mean, if you look at like a lot of these amazing tech startups, their founders are just clearly, obviously entrepreneurial people, but clearly just also geniuses. They saw something in the future and they went for building this. So where you now have a kind of a computer that can replicate some of those abilities, it just is immensely useful. Now, that doesn't mean we won't have some use cases where kind of some reasonable model will work. So eventually models will get good enough that some base model can do voice recognition. So eventually call centers will have some fairly cheap model that does voice recognition and even like the text to speech when the model speaks back to the person. That'll run on, it doesn't need to be the very latest one. Maybe when there's a complicated question, the model will be smart enough to route that to the smarter AI, but when it's normal conversation, that'll happen on some reasonable level of AI. Again, some corporate, like maybe, I don't know, optical character recognition task or some base tasks will run on that. But then typically, like for your coding, you want it to be faster, you want it to be done right, you want it to be done in the most efficient way. And also, I think the moment you get into these thinking models, what the leading labs have seen is, if you just throw the kind of the mythos model at it, the very smartest model for a complicated task, because the model is smarter, it can solve it in like 10 cycles, where the less smart model would have taken 100 cycles of thinking. So actually you might end up for any kind of complicated task, the smarter model will just get to the answer quickly. Like if you ask some very hard problem to one person that's an expert in that field versus like 10 people that's average in that field, often the expert's just going to get it much faster than the 10 average people in that field. So I think my gut is that people will just, for a lot of tasks, want the smartest models.
Cool. Maybe if we just move on to the software and the application layer of this cake. It's the one where there seems to be very little consensus, right? So, I mean, there's some very, very good investors saying, no, software is incredibly undervalued and is a great place to play. There's the other side of the coin where guys are saying software, SaaS is essentially dying as an industry because of these models, and we're short the whole book. Where do you stand currently on that kind of thinking, and how do you think it might play out?
Yeah, so this is a hard one, and probably since the end of last year, when we first saw the kind of these better models come out, we've debated this a lot and discussed it a lot, and we actually came up with a short list of about 20 software stocks globally that we wanted to implement as a short basket. And then as these things go, by that stage, these shares had already been down 20%. Maybe first the reason we want to do it, I made this point earlier that with these models, it is just now so much easier to develop software for companies. So let's say in our business, if there's some niche case where we need a specific piece of software to either track certain client data or keep some internal records for us, historically you have to see who's the external provider that does this best. Right now you can just say, can't we just build this with AI for ourselves, and it does exactly what we want? And maybe you've got to build your own thing, so it takes a little bit of time, but then you don't have to pay the other provider, and it exactly meets your needs. And I think as AI gets better, this use case becomes better and better. So any kind of software business that relied on subscriptions or companies using them to keep certain data in certain ways, you certainly are now going to face competition from either new startups that does it and charges half the price or a third of the price, or alternatively companies just insourcing. So no doubt about it to me that for any company, we always try to think, what's the range of outcomes this company could have over the next 5 or 10 years? And software was rated very highly because people thought it was a very tight cone of outcomes. Those companies grew 10 or 15% every year, margins pretty high and stable, and it was just a nice smooth grower. Now suddenly, like for some of them, maybe AI will be good because they will use it to improve their businesses and to take market share, and it could be good. But for many of them, it will be bad. So the range of outcomes is much wider, and typically markets don't like that because there's lots of uncertainty and you could lose money, and these things have massively derated. So the trick with these things always is, when you see it and you start believing this will happen, what is already in the share prices? And at that stage, when we looked at this, the shares were already down 20%, and we thought, okay, it clearly is bad for them, but it's already down, so we're probably a bit too late to the trade. And it's one of those very hard things in markets, knowing how early or late you are. And I mean, unfortunately, these things are down like another 30% from where we thought we were late to the trade. So maybe on these big mega trends, as long as you're like on top of things, you often are not late, and that's a lesson for us. And luckily on semiconductors, even when we had started doing deep work on these, some of these shares were up 100 or 200% in the previous 3 or 4 months. And normally our playbook would tell us you do not buy shares up 100 or 200% in the past 3 or 4 months. And fortunately, I think realizing this was a unique moment in history almost helped us get over that. And I think most of them are up 100 or 200% further from where we bought them. They are now up like 10x in a year. So obviously you've got to ask what's the right thing to do now. But it's always a hard thing in investments, figuring out, are you early and are you late? And does the market already hold your view, or do you have a unique view that's more in the future than the market?
Let me put you on the spot. What is the right thing to do now?
So on software, we are still saying it's too hard for us. Like we haven't kind of put it the short end now, because I guess you never know. Maybe we're not early anymore now, because it certainly is a very well debated topic right now. It's certainly way more out there than 6 months ago, which tells me at least a lot of it is potentially in the price. And I think one of the disciplines you have to have in markets is being willing to say sometimes something is just too hard. Like we don't have to at all times know how every sector will do globally. We just have to find a few where we're very sure. So like this last year, we were just these semiconductor companies that every large company in the world is sending all their free cash flow to, they're likely going to make a lot of money and go up. And that was just, so sometimes you just do the easiest thing. So software companies, maybe it's good, maybe it's really bad. Let's just not do anything there. And that's also fine. So right now we're in the just, let's watch and see how it goes. And maybe we have a view down the line that we can find some winners. But for now, it's just in the too hard box.
Cool. Okay, so I mean, maybe just now moving to put your PM hat on for a second and talk asset allocation, etc. And specifically, I think let's start with valuations. Obviously, there's a number of viewpoints in the market saying AI is a massive bubble, AI is overvalued, valuations are stretched, they're fair, and then there's the other side of it saying valuations are incredibly cheap. I mean, maybe let's talk specifically to various parts of it, but what's your take on those?
So if you think where the world will be in 5 or 10 or 15 years, I think it's highly likely that some very large part of the global economy and all companies just are either managed by AI, run on AI. So I just think this will be, the end game is this is potentially the vast majority of the overall economy at the end of the day. So as I mentioned earlier, I really do think it is different from previous cycles. So we are looking at with that hat on. Saying that, you always have to say, what is in the price right now? Versus what do we think the future will be. And clearly the market has figured out to some extent now that semiconductors are a key part of what we are building here and massively repriced that entire sector. So what we have been doing there is consistently kind of selling some of our exposure as these things have gotten closer to our fair values like we would normally do. Right now, the key debate we also have is like on the hyperscalers we spoke about, and a business like Meta, for example, that isn't a hyperscaler, but they can use AI to serve better ads to people, more appropriate ads, to improve Instagram and Facebook further, and to potentially build some new apps. So they could also potentially be an AI beneficiary down the line. A business like Tencent will use it to kind of build better games, and also on their social media front. Those shares have also been very weak. Like, unfortunately, we still held many of them because we think they're long-term winners here. I think I wish you had seen kind of a year ago that you should even rotate that part of your book into semiconductors, but unfortunately you can't see the future perfectly. So that's been kind of a tough area of the fund for us. However, we think of current valuations, they do seem pretty compellingly priced because a lot of them will grow 20, 25, 30% over the next few years as those cloud businesses accelerate. Businesses like Google, Amazon, even Microsoft, and Meta will have ad revenue accelerate significantly. So the question is, when eventually the market makes peace with the fact that the free cash flow is lower for a few years, but then earnings will accelerate, hopefully that's the time when those shares do well. So right now that is a meaningful part of the portfolio. As I said, semiconductors we've kept roughly flat, even though the shares have been up a lot. We sold quite a lot, but it's still a part of the portfolio. There might be a stage where we sell out completely. Who knows? But right now it does seem to us that it still feels fairly early on in this very long, bigger picture 10, 15-year cycle that I don't know if it's completely over for semiconductors despite how well they've done. And at the other side, we can obviously always look for interesting opportunities in SA, and where we significantly reduce South African exposure early in the year, we have been as the wars come to an end, somewhat increasing that again. So South Africa has been climbing in the mix, and it's almost as big as offshore. So right now, our normal stock picking, finding mispriced SA opportunities, that's kind of well positioned, and we think will do well over the next few years. That's also naturally a part of the portfolio where we consistently will try to make money on. So right now, we've, let's say, got the semiconductor exposure, the rest of the tech benefits. That's probably the second order beneficiaries of AI, and then South Africa.
Cool. I suppose one of the things worth mentioning here is that these are very volatile sectors. I mean, we've obviously seen it with the semiconductor businesses very recently, but every year there's a kind of a fresh, this is definitely a bubble moment. How do you hold conviction in those kind of names? How do you make sure that you don't flip and kind of sell out at the wrong point in time? But likewise, balance that with the acceptance that you don't want to introduce too much volatility into the funds.
So this is easier said than done. So there's the theory, and then obviously how you do it in practice. And as you said, it's right now probably the most volatile sector on Earth. So one of the things that gives us some comfort on a bubble at almost the system level is the fact that these companies, as I mentioned earlier, have somewhat slow rolled their expansions of capacity. They didn't expand for the first 6 or 12 months despite demand increasing because they didn't know if it would be permanent. And even right now, with demand signals being much more clear, a business like TSMC, that's really the underpin of a lot of the semiconductors being made, they are maybe expanding at like 15 or 20%. And I think their customers would like them to expand at 30 or 40%. So they are making sure the market stays somewhat tight for us. So I think the fact that it's this consolidated industry with some old hands that's seen a few rough cycles is probably giving us some time smoothing out the cycle and potentially helping us, saving us from the big boom and then the crazy bust. That's kind of our current base case on the system level. And then on the valuations, that's another story because they, as we mentioned, like a lot of these shares are up kind of 10 times in a year. The market typically has a very hard time when a share was worth 100 for like many years, and suddenly because of some structural changes now worth 300 or 500, it's just going to be very volatile repricing a share from 100 to 500. It's not going to go in a smooth straight line. It's going to go jumps and pulls back because no one knows is it worth 500 or 300 or 700. You can't fully be sure. So the way we do it is kind of the best way we know how to is when things run a lot and you've done well on something, you take some profits and you bank some of the profits and you either put it in cash or other shares. When it pulls back, you could buy it again. And you are not going to call either the bottom or the top perfectly. But if you try to capture a meaningful part of the move to fair value, that's kind of the best we can do. And that's still why we run a diversified portfolio. We're not going to put the whole fund in semis and have crazy volatility, even though that might be the highest potential return. Our job is to deliver at the end of the day a somewhat smooth return profile for investors, and that's what we aim for.
Cool. Okay, maybe just I see we're kind of getting towards the end of the thing. So just to zoom out a little bit, close with a somewhat wider view first. Practically speaking, how are you and the investment team utilizing these tools to assist you in kind of your role as investors?
It is, I'm not going to go into the exact specifics, but just say it's been incredibly useful for us, especially with what's going on in the world. We are covering a lot of new companies and sectors and trying to move really fast. I think that'll be required for all fund managers to stay on the bleeding edge of where the innovation and the technology change is happening. So that means a lot of new companies and a lot of new countries and sectors we've looked at. And the AI is just great to enhance our portfolio managers and analysts. It's easier to get research rather than having to phone around. The AI can often find the information for you. When there's specific parts of the sectors or the value chain you want to explore, you can dig deep. So it's been very useful to speed up our process and improved our knowledge. And then also across our business, there's many other areas where it's made us more efficient. So I think having an AI team and seeing how useful it's internally has actually made us money as investors because we've almost seen earlier, like we've tried to be like early adopters. We want to be the best in SA at this. And by seeing that in our business, you can just see other companies are going to figure this out in the next 6 or 12 months and they're going to want to spend a lot on it. So our internal token use is up, like, I don't know, 10, 20x over the last 9 months as well, if we see what we're spending on AI tokens.
Maybe just going back to the kind of specifically for the role of the analyst within all this. I heard it mentioned on a podcast a while ago. Someone was kind of said that the AI is an exceptional researcher and an exceptional journalist, but the job of the analyst is now to apply the wisdom above that.
Yes.
Does that kind of fit the mold for you?
Yeah, that's pretty much exactly how we'd be using it. I think your portfolio managers and your analysts have looked at a lot of things in markets. There's always gathering the facts, but then there's the judgment of what is priced into the market, like what does the market think versus what we think. So it's really good getting the technical understanding. It's not on a level where you let it make decisions. That's kind of the job of our analysts and fund managers. But it certainly has made you, like the analyst with AI is better than the analyst alone, right? Because you apply the judgment of the human with the details that the AI can get you.
A question here, which I'm just going to dive into because maybe it pulls into another one. But first of all, the question that's come through is around SpaceX and kind of its role in, well, its IPO, and obviously the share price has been incredibly volatile. But so maybe views on SpaceX would be one thing, but then the second thing is Anthropic and OpenAI are obviously going to be coming to market at some point this year as well. Those are going to be two absolutely massive IPOs. What is the risk in terms of how that is funded by the kind of broader investment community?
Yeah, I think it's an extremely exciting year for IPOs, right? Three of the most epic companies in human history has come into market, and especially SpaceX. I think what Elon's done for the world is just incredible, getting people excited and dreaming about space and a technological future again. So on SpaceX specifically, we did apply for quite a lot in the IPO. Unfortunately, in SA, you're quite far away from the US where these allocations get made. Unfortunately, only got a small allocation of versus what we applied for, and it's been a good one. I think we made about 40%, but we, like, our view was always, it's a very safe trade for the first few weeks because they're only placing a small amount. None of the other holders can sell, so it's very likely that there's more buy pressure than sell pressure, and it ended up working very well, but unfortunately on a small position size. The key for this and these other IPOs coming down is there will be initial placing that's not such a huge amount. Maybe I think it was $75 or $80 billion for SpaceX. The issue then is when all the shares are kind of the lockup expires. So currently existing shareholders of SpaceX cannot sell, but obviously there's $2 trillion of potential sellers that start from August. This lockup start expiring all the way through January, so there's potentially a lot of stock that can hit the market. The same will happen for Anthropic and OpenAI. Initially, there'll be a $100 billion listing or something, but then there'll be $1 trillion or $2 trillion that frees up over a period of time. That is big numbers, even by the scale of US capital markets. So a big debate we've had is how do you position the fund into that? And clearly what people will sell is other large holdings, and that's probably already somewhat impacting these other large tech companies, but it potentially will impact the whole market as people have to sell other things to buy these exciting new businesses. So while it's really nice to have these exciting businesses listed, I think it is potentially a time you've got to be careful, and we're running slightly lower net than usual, partly worried about this overhang and wanting to see how this gets absorbed by markets.
Maybe just carrying on SpaceX, how did anyone manage to get to the valuation that was achieved by Elon on that business? Because it was quite exceptional.
So look, there's a lot of hopes and dreams in that valuation, and it was quite funny. We had a call with the Goldman Sachs analyst that obviously had to put out this research report to justify the current valuation. And you could see even this guy on the call, like he was struggling to believe his own story that he had to get to. It's very hard to get to that on current numbers, but obviously Elon kind of, what price do you put on Elon doing awesome things in the future? And maybe data centers do work in space, and maybe he can build his own chip business in the US. So shares do try to price in the future, and with Elon, there's a lot that could happen in the future that's not currently in the price. So you're really buying more story than current earnings. There's no doubt about that.
Yeah, fair enough. Okay, I'm conscious that we've only got a couple of minutes left of time, so I'm gonna ask you one final question here. For advisors and investors listening right now who feel that they might have missed this AI trend, who feel that they're late to, I suppose, particularly from a personal adoption perspective. Like, it feels very overwhelming to try and start to utilize these tools, get out there and add them to your business. Any advice in terms of how to get up that skill curve in the AI space?
So I think what I tell all my kind of friends and family members and even people at our work is, just get yourself one of the subscriptions, probably to Anthropic right now, they're the best model, or to ChatGPT. At least go on the $20 subscription. This is going to be the thing that defines work and probably how humans work for the next 20 years. So you want to be a kind of a power user, understand it early on. So get on it early and just try stuff. Like, I don't know, I spend a lot of time asking stuff about my kids, like health situations you deal with, or like kind of any kind of issue that the kids has, and like any kind of question work, you put it in there. The beautiful thing of the AI is you can also ask it to train you, like, how do I use you better? This is my life, where can you help me? You can literally just ask that. So just spend more time asking the AI questions. And I think on the investing side, I don't really think there's a choice to like ignore this and hope this goes away. This is just like I said, in 30 years, like the whole market will just be AI. Okay, that's just going to be how it is. So So I don't think there's a case of being too late on any trade. Clearly, this has to be part of any portfolio or part of the toolkit of any portfolio to invest in this. Maybe you don't chase something in the short term, but certainly building any portfolio that will survive and thrive in the next 10 or 20 years, this will be a vital part of it. So best either get involved yourself or get a manager that has a view on it and that will invest in that space. But I don't think there's a choice to kind of avoid the cycle, either personally or in your portfolio.
Fair enough. And then one final question, maybe just what are the knock-on effects, I think, for markets, but maybe more for society, that worry you about AI generally, or things that you think haven't been necessarily considered fully by society?
So I'm actually mostly extremely excited. I think this will give us potentially the most exciting future for humanity you could possibly have. And there really are, I think the very high likelihood is that it'll lead to like radical abundance, and people's standards of living will be incredibly higher. Like right now, we always say like a typical human today maybe lives better than the King of England lived 200 years ago. I think there's a chance that a typical human, like in 30 years from now, lives better than like Jeff Bezos lives today with AI and what it can do for you and how cheap things will be and the like. Saying that, so that's the exciting vision of the future. Saying that, the hard part will be how fast I think this might happen. And it's just we might have to reconfigure how a lot of jobs and things in society works over quite a short period of time. I actually think the risk over the next 3 to 5 years is not that high, but let's say 5 to 15 years out, there potentially might be quite big changes in society that I think things work out great in the end, but just the speed of change will potentially be tricky for people to handle. And I actually don't know if people wonder will it be harder for young people because how will they work, but also for people existing in the existing workforce, it might be as hard. So I'm actually not sure who it's going to be more tricky to navigate for.
Okay, we're gonna finish up there, guys. But I think hopefully you got a lot of optimism out of that, and some really nice insights. Thank you all so much for joining us. I did not get to many questions. I am sorry about that, but we will respond to you offline, and we really do appreciate your time. Thanks very much, everyone.